price oscillators. They always look so great when you study them, but they never quite hold up when you go to use them in real time. In today's video, I want to talk about the problems with oscillators, their main drawbacks, as well as what I think are the best ways to apply them in the market. Let's take a look at McDonald's as our first example. This you can see really is what is problem number one. The RSI in the bottom panel, which is the relative strength index, is probably one of the most popular price oscillators out there. And look at how perfect this looks with McDonald's. Every time it's oversold, the stock bottoms. Every time it's overbought, the stock peaks. So what's the problem? Well, everyone learns how to use price oscillators, and they always typically learn with what are these perfect examples. And the reality is the market doesn't really work that way. So the problem number one is that the indicators are a lot less effective than what you think of just by studying these perfect examples of the oscillators with these sideways markets or sideways stocks. The reality is stocks trend far more than what this chart is showing. And if you use it in a trending environment, simply selling because it's overbought can be very painful. That leads us to the next example, which is Tesla. Take a look at this chart here where Tesla went on this epic advance. And you can see if you would have sold the stock when it first got overbought, it went up another 1,200% in a few months before it peaked. So the question is, what are you trying to capture with your system? If you're looking for stocks that are going to trend, selling because things are overbought is not going to work. You're going to be including an indicator that's going to work against your stated goal. The reality is you should only be applying this tool to sideways markets. And if you do sell or go short because it's overbought, or if you do buy because it's oversold, you need to have a risk mitigation plan where what if you embark on a new trend? You need to be able to cut your losses and step aside because, as you saw with Tesla, sometimes you can get overbought way before the trend ends. Actually, let's take a look at this next example, which is Nvidia, which has been one of the key winners of the 2023 to 2024 bull market. And you can see there's been relentless sell signals during the entire powerful uptrend. So this really kind of comes to problem number two, the impact on your mindset. Even if you say to yourself, I'm not going to be selling just because it's overbought, I guarantee you, if you have an RSI under all of your charts, even if you're looking to run a trend following system and it's not part of your toolkit, but it's on your charts, it's going to influence your mindset negatively. Whenever you see it extremely overbought, it's going to be difficult to go in and buy stock. And so simply kind of having it on your charts, if it's not part of your approach, and if you're a trend follower, it's going to negatively impact your thought process because it's always going to be showing you overbought when you enter into an uptrend. Or when you should be cutting your losses and getting out, it's going to show oversold and tempt you to not cut your losses. But if it's a new downtrend, you'll be in big trouble because things will kind of keep falling if a new trend kind of kicks off. So that's a second big problem, is how I think it can deceive you and overly influence your mindset if a new trend is kicking off and you're relying on this indicator. Problem number three is people tend to stack multiple price oscillators on the same chart. If you look at this next chart, there's the RSI, which we already discussed, the MACD, and Stochastics. All three are three of the most popular price oscillators. And you can see, yeah, there's some difference to the squiggles. Everyone's always going to have their preferred oscillator because they all have slight variations. But by and large, you can see they all get overbought at the same time. They all get oversold at the same time. So you're not really getting additional information, additional data into your thought process by throwing on multiple oscillators on your chart. I'm always very careful, very precise about which indicators I use. Every time I use an indicator, it has to bring new data, a new perspective to the equation for me to have it on my chart or to have it as part of my investing process. In fact, I actually put together a white paper where I discuss my 5 favorite indicators and I show how each indicator really brings a different data point and a different perspective. You can get the link to that below this video, and you can get that for free by downloading it. So that's, I think, a major drawback because early on, I kind of fell victim to that. I said, hey, look, if I have 3 or 4 indicators and they all show me a buy signal, it's a more powerful signal. That's not the case. They're all basically just taking the same price data, but just, working with it slightly different, and you're getting a same general answer. So let's now talk about a couple of ways that I think you should use oscillators. And it's important to understand these different variations because we're looking at price oscillators today, but the same concept will really apply to different oscillators with different types of data. Even if it's economic data or market breadth data, whenever you put it into oscillator format, they tend to have the same kind of response to the market. So the way I like to use oscillators primarily is to look at the range shifts. So by that I mean, we kind of alluded to it when we were looking at Tesla and Nvidia, but it's interesting that if a stock is in a major uptrend, you will get extremely high overbought readings. So in this situation, it's quite odd, whereas if you get a small overbought reading, it's probably bearish for the stock. But if you get an extremely overbought reading, it's such a powerful reading that only a stock in an uptrend can really kind of bring those kind of readings. So if you take a look at Netflix, this next chart, you'll see that if you had this price oscillator on, but if you didn't use it as a way to sell at overbought or bought or oversold, but if you looked at when is this stock reaching extremely overbought readings, you said, oh, we must be starting a new uptrend. It would have been a great tool to identify that new uptrends were starting. Similarly, if you saw extremely oversold readings, if you saw that the stock fell so hard that you triggered these very low readings, you'll see that that's typically the point where a new downtrend is starting. So rather than use the tool for overbought and oversold, you could really use it as that, hey, if we get extremely overbought, and you look at the past times where usually it's over a reading of 80 or 85, whenever we get to those extreme readings, chances are you're embarking on a new trend upwards. And if it's a very low reading at, let's say, 15 or 10, you're probably embarking on a new downtrend. So which is kind of the exact opposite of how most people will come to use the tools. But I found that to be a very, very effective tool, and it never has you fighting a trend, which is very important. The next way to use this tool is really with a specific purpose and process. So it does make sense, obviously, sometimes to fade the market. If things are overbought, it does make sense to sell or go short. And if things are oversold, it makes sense to try and buy it. But you have to know that you're not in a trending market. So how do you know that? Well, I think you have to begin with figuring out what instrument you're trading. If you're working with a volatile growth stock or something that has a brand new catalyst, like Nvidia when they came out with these new chips and all this ChatGPT and this AI trend, you don't want to be fading that just because you have an overbought reading. However, if you have what I think is one of the better ways to use it is, let's say, in the commodities market, something like oil. If we look at oil, this chart here, I mean, oil is a widely traded, commodity. It's available all over the world. It's a very efficient market. Most of the time, you're in these very tight ranges where it makes sense to sell when it's overbought and buy when it's oversold. In fact, most of the times commodities are not embarking on major trends because it's a commodity. That means it's readily available and it makes sense that its price is relatively stagnant. So what's the caveat here? How does, if it's so simple, just easy to make money, the situation is you can see here, even though they're those tight ranges, every so often a new trend develops. What kicks off those trends is a new catalyst. So if you're trading a range-bound market, you have to always be on the lookout for a new catalyst. So here, the first major drop in oil was due to the financial crisis, where there was demand destruction, where people were not using oil as much. The second major drop was due to the shale oil boom in the United States, new technology, which they got a lot more oil on the market, and we got a big drop. Then we had the COVID shutdowns, which basically, again, killed demand. And then ultimately, we had the resumption where the Fed kind of pumped all this money into the market. We had the original COVID vaccines that came out that gave everyone the confidence that they wouldn't be locked down anymore. And that had a surge in demand at the same time when supply was shut in. So you had this huge move of oil off the bottom into new highs. So using price oscillators in range-bound markets work great. Typically, that should be a sleepy stock, a commodity, a stock that doesn't have any kind of major growth driver or catalyst. And if you do use it in those environments, you have to always be aware if you get some extreme readings and it breaks out of its range, is there a new catalyst? You have to look around what's going on in this market that I'm unaware of that's causing it to kind of get to really more extreme upside or downside readings, and should you cut your loss and move on from the trade? So price oscillators can be effective. I think there's a place for them. I think there's an over-reliance on them because they're shown and taught in an overly optimistic way. But I think using them in the right light, using them in the right way, they can bring value, but they need to be part of an intelligent system that works together. Again, if you're a trend follower, they're probably not going to be very helpful, maybe to help figure out if you're in a new uptrend by looking at extreme readings or a new downtrend. If you are going to be selling overbought and oversold, that means that's really kind of the system you're applying. You have to be aware of new catalysts. You really need to kind of put it in its proper place. And then just like anything else, it's an effective tool. It's not a trading system on its own. You need risk mitigation, you need proper sizing, and you have to be able to kind of adjust for the unknown. But those are the problems, those are some of the solutions, and I hope you enjoyed this video. You can follow me on my website at carusoinsights.com, as well as on Twitter at trader_mcaruso. We'll be back with some new videos soon. Talk to you then.